We're ready to go. Good morning for our speaker, Efrat, in the US. Most of you, as far as I can see from your names, from Europe, and for those that are here like me, Ben, good evening or almost good night. It's 11:34 p.m. here in Tokyo. It's great to have you here for this webinar number 25 on February 22nd, 2019. As usual, let me give you a short introduction to the help desk and to this slide that you see in front of you, in which you have my email address if you want to reach out and get in touch with me. You have the website URL of the website of the help desk, the URL of the survey that we are running constantly on SMEs, and of course the last URL for the registration to the newsletter that we send quarterly to our subscribers. It's great to have with us today once again Efrat Kasznik from Palo Alto, from California. Welcome, Efrat, if you can hear me.
Thank you, Luca. Thank you, Luca. Welcome, everyone.
Thank you, Efrat, for the double effort, not just for donating your time for us, but also for being up so early in the morning. So double appreciation. Today, you're going to talk to us about how to tell your story with numbers, building a fundable financial model for your startup. Before giving the word to Efrat, I would like to introduce her to those that do not know her yet. Efrat is an IP evaluation and strategy expert with over 20 years of experience assisting clients with the valuation and monetization of their intellectual property. She's the founder and president of Foresight Valuation Group, which is a Silicon Valley-based IP valuation and startup advisory firm, as well as a lecturer on IP management at the Stanford Graduate School of Business. Efrat serves as a chair of the high-tech sector of the Licensing Executive Society and has been listed on the IAM Strategy 300 list of leading IP strategists every year since 2013. Throughout their career, Efrat was a co-founder advisor to several Silicon Valley startups and is currently a mentor and advisor to startup accelerators in the US, Europe, and Israel. And also, I would say, an occasional lecturer for the help desk here in Japan. So without further ado, welcome, Efrat, again with us. Thank you for your time, and the floor is yours.
Thank you, Luca. Thank you for inviting me again. This is the third webinar I give to the EU-Japan help desk, and I'm very excited about this one specifically. So a little bit about my background, as Luca mentioned. I have a background specifically in IP valuation, which is kind of my main area of expertise, where I run Foresight Valuation Group in Silicon Valley. I also like teaching and lecturing, which is why I'm doing these webinars. I've been teaching at Stanford for a few years now, different classes around IP and around startup valuation and strategy. I'm very active with the IP community. But I'm also very active in the startup community, and working with startups has been a passion of mine. I myself have been a co-founder, an advisor, a CFO, and held a variety of positions in various startups in Silicon Valley, different technologies. So when I'm not a consultant, I'm a founder. So I presume we have a few founders or people who would like to jump into the startup world with us today. And today we'll talk about financial modeling for startups. So this is what we're going to talk about today. So, I just want to start by saying that financial modeling, so the financial part of the startup slide deck is usually the last thing that people do if they do. So a lot of times, and I've worked with hundreds of startups throughout my career, people come to me and they have this beautiful slide deck and the product and the market and everything is graphically excellent. And then people say to me something like, can you just help me fill in those two slides of the financials, you know? And those two slides of the financials, if you don't have that, then in my mind, it's a big problem. And it shouldn't be the last thing in my mind. It should be one of the first things that you do, particularly if you're asking for money from someone. So when I give this talk a lot through in Silicon Valley as well as in Stanford, the talk that you'll hear today, which is a short version of a 2.5-hour workshop that sometimes I give for a whole day even, but the standard version is 2.5 hours. So we'll try and cram it kind of in the 45, 50 minutes that we have. But the idea here is, and I will try to get kind of all the key concepts to you. The idea here is that if you ask somebody to give you money, you need to be able to show how you're going to use this money and how it's going to turn a return for your investor. So that's a very simple concept. And a lot of people think about, oh, we'll get the money and then we'll worry about it later. So my philosophy is that is really, first, it's unfair to your investor. And it's really a very risky way to deal with money. So I think that there's a few things that every startup should know regarding financial modeling and how to actually model your financial performance. And if you can do that, then you'll be better off in terms of being able to utilize your money longer and getting a better return for your investors. So this is kind of the high level why we need this. And hopefully I've convinced you, and hopefully you'll gain some wisdom over the next 40-45 minutes that you spend with me. So the way I'm gonna, this is a webinar, so it's not this talk is usually very interactive. So I'll try and with the confines of a webinar, convey a few things to you, and I would encourage you to email me or contact me later if you have any questions. And a lot of these things can be expanded into many different industries and many different products. So we're going to start and talk about the cost of growth, which is kind of the basis of why you need a financial model. We're going to then continue and talk about a little bit about the connection between the business model and the financial model, which is kind of the starting point of every financial model. We'll then go into what are some of the fundamentals of financial modeling, just touch on a few key concepts. And then we're going to conclude with with an example. We'll walk you through an example of some of the common financial modeling mistakes that we see and how to avoid them. So this is the outline for today. We're going to get started with the concept of the cost of growth. So I'm on slide 5 now. When we talk about startup funding, so let's take a step back. What are the sources of money for a startup? So you see a few things on this slide. You see crowdfunding, you see grants, if you're in the sciences. You see debt, which is a loan, which is usually not a great option for startups just because they don't have the cash flow to take a loan. So really what we're talking about equity. And just to give a definition, when I talk about equity, for those who may not be super familiar with the concept, equity means that somebody is giving you money in return for a holding, so shares in your company. So that's what we're talking about. So it's a very specific situation. I mean, it's very common for startups, but it's very specific to startups as well. And there's a few things that come with the equity investment. Some of that is done through, or most of that is done through venture capital, but it can also be done through private investors, angel investors at the early stages, private equity firms. There's a lot of types of investors that would give you an equity investment. So when you build a financial model, just keep in mind that this is an equity investor that we're talking about. So the next thing I want to show is and again, I want to kind of highlight the concept of the cost of growth. So this is, and when I do this talk, if you were sitting in front of me, I would ask you, do you recognize this company? But since we don't have the benefit of interaction, I would just tell you that this is what we call a hockey stick. So this is a valuation growth trajectory of a real company called Dollar Shave Club. And this company sold for $1 billion. You can see up here at the very end. You can see that this is the end of this company. So I had a very successful exit and had a growth that looks like this, which is what we call a hockey stick, which every startup would like to eventually be able to show. This is kind of the dream of startups. So, you know, this is great because you see this company started in 2012 with $5 million in valuation and ended up with $1 billion in 4 years, which is really incredible. So this is a great picture, but there's something missing in this picture. What is missing in this picture? And this is kind of the story of Unilever, which bought this company, which is in the business of selling disposable razors in a subscription model. So they kind of disrupted an industry, and disruption is what every startup would like to show. And they got a great exit, which is what we call this $1 billion acquisition. So what's missing in the picture? What's missing in the picture is the cost of growth. So you can't really grow from here, 5 million to 1 billion in 4 years without funding. It's really quite impossible. So you can't, even if you have the highest sales in the world and you're very efficient and you're generating tons of cash flow, there's no way that you can grow from here to here without funding. And funding, when I talk about funding, again, we're talking about equity funding, is the money that you need to fill in the gap that allows you to grow from here to here, okay? And so the green boxes here show the funding amounts that this company took in various periods of time. So there's a few things we can say about it, and I'm not going to spend a lot of time. There's a whole different talk that I give about funding strategy, and if I end up working with you, we can kind of design the funding strategy for your own company. But the key here is, as you can see, the company is raising increasing amounts of money as their valuation grows. So this is kind of best practices for funding. You want to grow what we call every time there's an inflection point, and an inflection point are the points here where your valuation goes up. You want to raise the right amount of money at the right amount of time. But generally speaking, this company has raised $165 million to get to $1 billion in valuation. And that's very typical, okay? That's not by no means a crazy amount, especially for a company like that. So since we know, or we can do many examples like that there's a high cost to growth, especially if your growth is on a hockey stick, like accelerated growth, the financial modeling of your company becomes even more critical, because the financial modeling is going to tell you a few things. Financial model is going to show you, you're going to be able to model this valuation growth, make a picture for the next 5 years, which is how I do it. I always look out 5 years, at least 5 years. It's also going to show you how much money you need to bring in. So that's very important. So people usually stop at the revenue line and say, okay, you go and show an investor a chart, show crazy revenues, and they don't believe you. Why don't they not believe you? Because a lot of companies don't model the cost. And that's one of my key messages today is we're going to look at revenues, but we're also going to look at cost. And that bring cost and revenue together. These are the fundamentals of a financial model. And another thing that I want to show you, and I'm on the next slide now, is that really when you think about a financial model, these are examples. Don't get hung up on the numbers too much, but just look at the chart below here. This is a printout from a real client that we did, a software company. And what you can see, color coded lines. You can see a blue line, a green line, and a red line. So accounts, this is the growth, this is the funding, cumulative funding, and this is the revenue. So what's important here is that if you want to grow, I'm pointing to the red revenue line. If you're going to grow like this, that's fine, as long as you understand that your cumulative funding is going to look like this. Okay, so, and I'm pointing at the red funding line. So what part of the problem is with startups is that people show the red revenue line, but they show the blue funding line, okay? So they don't understand the cost of growth. And it's really, really, really important. And the one thing I also hear people say is that we're going to grow aggressively or we're going to grow conservatively. And I don't really like the aggressive conservative language. You can grow at a higher pace or you can grow at a lower pace, which is fine, as long as you understand that you need to bring in the right amount of cost. So you can show, it's perfectly fine to show the red financial model. There's nothing wrong with that, as long as you show the red cost line with it and not the blue cost line. So that's kind of a lot of what I'm going to talk about today would tie back into that. And when we talk about the example at the end, I'm going to show you some real numbers again of a company that we worked with that started out with something like the red revenue line and the blue cost line, and we helped kind of bring it up back into the red line. Okay, so that's the cost of growth. Really important concept to understand. The next thing I want to talk about is once you approach financial modeling and you understand that you need to figure out what is the cost and what is the revenue trajectory that you're going to show and what is the cost of that. The first question for everyone is, what is your business model? So that's the first question I ask every startup that comes through the door that I work with. And before we do that, let's lay out the goals of financial modeling so we're all on the same page. So when we talk about a financial model, before we get to the business model, there's really a few goals that any company should have in mind. The first thing is really to manage investor expectations. So it's not so much about promising the investor something. It's about managing expectations. So you don't want to be too high. You don't be too low. You want to be always in a place where you understand your growth curve and you also understand how to get there from a cost perspective. And this is true for every company, not just a startup. It's true for a public company that deals with public investors as well. So that's the first thing. The next thing is set the foundation for your funding strategy, which we already talked about, your cash projections and valuation trajectory, set up your funding strategy. And one important concept that I mentioned briefly is you want to manage your dilution to a minimum. So when I talk about dilution, every time you bring in equity money, so once again, we're in the world of equity, every time when you bring in equity money, it eats away of the holdings of the existing shareholders. This is how technically this thing works. So you have to be very careful about the money that you bring in. You have to make sure you bring in the right amount of money, so not too much, or also not too little. And also you want to make sure you bring the right amount of money when you have the right valuation for that. So if you bring money at a point where your company hasn't reached a point of evaluation that's high enough, then the new shareholders will eat away a much higher percentage of the holdings of the existing shareholders, and that's not a good situation for anyone. Lastly, a financial model is used to create an operating budget. So again, when you take money from somebody else, you need to make sure that you know how to spend it. So prioritizing spending is really important. And also understanding when is the next time you need funding, because the startup is always usually kind of chasing its tail. So as soon as you get funding, you should start looking at the next funding if you're growing fast. So these are kind of the goals to keep in mind. So going back to the business model. So this is a simple chart that I use. You can make it as complicated as you want, but this works, I would say, for 90% of the startups that I see, unless you're in a business that is very unique, that doesn't fall under this chart. So let's look at that. So the first question that you should ask yourself is, what is your product? And as I mentioned, most startups would either fall in the software category or in the hardware category. If you're in the sciences, that's what I call technology. Down here, you might be developing something for licensing. That's true for a lot of universities because I know, I presume in previous webinars, we've had a few university people online. So I put that node on the side here. But let's really talk about software and hardware and a combination thereof. So a lot of companies, a lot of like connected devices, your hardware and software. So you can do both. So if you're in the software or in the hardware, the next question you should ask yourself is, if you're in a hardware company, you should ask yourself, are you going to manufacture it, or are you going to license it, and then you kind of end up here, to somebody else to manufacture? So that's the next question for a hardware company. And then both the software and the hardware companies end up in one of two nodes. Are you B2B, business to business, or are you B2C, business to consumer? And that's a really important question because it impacts a lot your revenue model. And your revenue model then impacts your cost model, which is kind of what we're trying to get at with the financial model. So without having an understanding of this whole business model selection concept, in my mind, you can't really do anything. I mean, you can build a product, but, and I'm not a product expert, but at the end of the day, you need to sooner than later figure out what is your business model. So let's talk about software. So I just want to give an example. So let's say that you have a software product, which is a lot of the companies that I see, and the example I'm going to give today is also a software example, just to give you a heads up. And let's say that you are business to business. So you're selling to businesses as opposed to selling to the end consumer. What is the implication of that? Okay, so let's go to the next slide. So on this slide, I've plotted kind of a pretty exhaustive list. I mean, you could add more to that, but this is a pretty representative list of the revenue sources of a company. So if you're in the software B2B business, going here, these are the revenues of this whole list that you can go after. You can go after subscription, you can go after data mining, you can go after licensing, okay, of software. So these are some examples of what you can go after. You wouldn't necessarily go after a lot of the other things which are not part of the B2B business model. And I would also urge you to stick with one or two at the most revenue sources. Like companies have the tendency to want to show many revenue sources to investors. And that's usually not a good strategy, just because it shows kind of lack of focus. You really need to focus on one or two at the most and do them well. So you need to show that you understand the fundamentals of the financial model that you're going with, which is what we're going to talk about next. It's very complicated to even do it well with one revenue model. But I just wanted to kind of give you some idea. So this is if you were selling software to businesses. Let's go back to the business model selection chart. And let's say that you are in the software business selling to consumers. Okay, so this is the B2C business model. Okay, so we started from up here and kind of went down the line here. Hopefully you can see the green arrow and then ended up here. If this is your business model, let's say you're in a mobile app. Okay, a lot of people like to build mobile apps and they want to go direct to consumers. Not a very easy thing to do, but let's say that that's what you want to do. Let's go back to our revenue slide. Your revenue sources are going to be very different, okay? So if you remember before, we talked about subscriptions, we talked about licensing. When you sell to consumers, they don't like to pay. So I usually say that to a lot of companies that come and say, oh, we're going to charge for the app. Well, that's usually not a good idea. If you want to grow, you kind of want to give up your B2C, people just don't like to pay. So let's say that they're not paying. You do need to make money somehow. So your revenue sources, if you're in the B2C portion of the software business model, are very different than the B2B business model. So you have advertising, and you have freemium, which means people upgrade for premium features and they pay for them. You have in-app sales. If you ever played games, you would know what that is. The sponsorship. So there's all sorts of revenues that are different from the revenues I showed you before. So, so what I want to relate to you when I show you this slide is that you need to figure out what is your business model, And your business model is going to dictate your revenue sources and your financial model. So that's a very important preliminary stage that every company should go through. Okay, so we talked about the cost of growth and we talked about selecting your financial model. Let's talk a little bit about financial modeling fundamentals. Okay, so a lot of companies that I see would come and say something like, it's $1 billion industry, and you've probably seen those like TAM and SAM, like the addressable market slides. And if we only had 1% of this market, we would have, millions and millions of dollars in our sales, and we're going to grow 50% every, and you kind of build it from the top down. I want to discourage you from doing that. This is the wrong way to build a financial model. What I would like you to think about is I would like you to actually go and think about it in reverse. So the way I advocate that companies build a financial model is from the inside out. So I advocate companies to think about the unit. Always think about the unit. What is one user? What is one unit of product going to cost you? Really work the micro economics of your product before you start thinking about the big market. There is a big market out there. You don't have to show the percentage of the market. That's really not the right way to look at it. So the first thing that I like to stress is the unit economics. So I'm going to give you kind of the three pillars of financial model the way I see them. The first one is unit economics, which is what is the marginal cost, and I'm going to explain what I mean by marginal, and revenue from each unit that you make. This is the first question you should ask yourself. If you don't know the answer to that, you can't build a financial model. That's my philosophy to that. If you ever watched Shark Tank, which we watch a lot in the U.S., the investors in the panel, the first question that they ask a company is, how much does it cost you to make it, and how much are you going to make on it? And it is a kind of a basic economic question. You'll be surprised how many companies don't have the answer to that. Now, you would tell me, if you were sitting in front of me, somebody would raise their hand and say, well, don't you need to have experience with the product to know that? And to that, I would say yes, but you need to start thinking about it from day one. You need to lay the foundation from that. You need to show an investor that you can think about it. If you don't do that, you have no business starting a company, really. So unit economics is really important. The next thing I want to talk about is people. So people generate revenues and create a cost. Remember, we talked about cost, revenue, and cost. These are always the things that should guide you. It's actually the number one cost in most startups, especially a software startup. It's like 95% of the cost is people, okay? And yet, when you ask the company, a lot of the early stage companies that I see, show me your organization. How many people do you have in your model? They have no idea. They don't build the model from the ground up or from the inside out or however. They don't really think about how many people they need. And as a result of that, your most important cost, you don't know. So I'm going to show you a few ways to think about people and how to figure out really quickly if you have enough people in the model. And the last thing is industry ratios. So when we talk about ratios, so another common mistake that I see is that startups are modeling their expenses as a percentage of revenue, as if you were an established company. So what you have to remember is that, so you say like, okay, I'm going to have $1 million in revenue, 20% of that is marketing. That's $200,000. That doesn't work for a startup, especially in the early stage, especially if you're a software company. Why? Because for a lot of these startups, the cost is over 100% of the revenue. That's why you need funding, right? If you had a cost, if you had enough margin left, enough cash generated, you wouldn't need funding. Or if you wanted to grow slowly. I mean, if you want to grow fast, you always need funding. So the very basic idea of a startup is that you a lot of times have costs before you have revenue, or you have costs that exceed your revenue. Okay, so if you model as a percentage of revenue, then you're starting off on the wrong foot. So you really need to build the cost sometimes almost separately from the revenue. Really looking at how many people you need to sell something or to do something or whatever other costs you have in the model, which we're going to show some examples of that. And then there are industry benchmarks. So every industry has benchmarks, even for early stage startups. And I'm going to show you some of them. But just remember, don't do a percentage of revenue in the early years. That's really not a good way to model cost for a startup. And cost is really important. As I showed you, the cost in your model determines pretty much how much funding you need. So you really need to have a good handle on your cost. Okay, so these are the three fundamentals that I'm going to talk about: units, people, and industry ratios. And then we're going to show an example, or we're going to show examples throughout that. Okay, we're going to start with unit economics. Now, so my philosophy, as I already mentioned, is you build from the inside out. You identify your modeling unit. What is it? What is the unit in your model? It can be a user, it can be a product, it can be a subscriber. Whatever your business model is, remember business model, whatever your revenue model that's coming out of that is what dictates what's your modeling unit. Now, unit economics are really important. We're talking about the incremental. So what is the cost that one user is going to incur? So not what your entire cost in your company. Think about to add one user, to build one product, what is the cost of that? And the flip side of that is how much revenue is this user going to generate you throughout their lifetime. Okay, we're looking at lifetime. So some of the concepts here are customer acquisition costs, which you, especially if you're in software, you're going to hear a lot, but I argue that customer acquisition costs should be something that every company should know. So one of the first questions that I ask companies is, what does it cost you to acquire a customer? Most people don't know that. Customer lifetime value, really, really, really important concept. I've been around this for a long time, so the more I deal with customer lifetime value, the more convinced I am that this is one of the most important metrics for every business. Like you can tell if a company is going to survive or die just based on their customer lifetime value. It's really eye-opening. Next one that I want to mention is annual recurring revenue. So this is, again, I'm going to do a software as a service, SaaS example. So these are kind of software, but really any industry you can think about, recurring revenues or monthly revenues or annual revenues. And lastly is the churn. The churn is really important, especially in a software company, but any company that has a user base, even if you're selling printers, even if you're selling like physical objects, if you're selling to people, you want them to come back and buy from you. So that's kind of the lifetime value concept. So many industries are moving away from kind of the one-time sale into a lifetime. So if you think about a lifetime, you think about churn becomes really important, your attrition rate. So how many people leave you every month or every year, right, or throughout their lifetime. And it's really, really important to know this feature, know this metric. You won't know it from day one, but you can plan for it and try to manage it to a minimum. Okay, so with this in mind, let's look at one example. We're talking about unit economics. We're talking about software as a service company. Okay, so I'm going to show the whole slide. Okay, sorry. Okay, so it's a little busy, but I'm going to walk you through that. It'll make sense. Trust me. This is an example I show every time, and it's really eye-opening. So we're talking about customer acquisition costs and the lifetime value, the monthly recurring revenue, and the churn. These are the concepts that I introduced to you in the previous slide. So the customer acquisition cost is defined as the sum of all the sales and marketing that you have over a period, let's say a year, divided by how many new customers were added. It's a very, very important concept for software companies. The next thing I want to talk about is the lifetime value. So the lifetime is defined as 1 over the churn. So if your churn rate is 2%, that 1 over 2% would be your life in months, 50 months. Lifetime value, the definition of that would be the monthly recurring revenue times the customer lifetime. Okay, so let me show you let's move away from the formula. Let me show you some numbers. It will all make sense, I promise you. So let's look at unit economics. Now, why is it so important to model using unit economics? When you go to a SaaS investor, a software investor, they all know these ratios. So an investor is not necessarily going to look at your trajectory or anything like that. They're going to very quickly look at your unit economics. So they're going to do these calculations that I'm showing you now, which are very easy to do. And immediately they can tell if you know your stuff or you don't. Okay. So if you're presenting a SaaS model, there's many ratios. There's hundreds of ratios. But let's talk about two of the most important unit economics ratios. One is the relationship between the lifetime value and the customer acquisition cost. Your lifetime value, after you calculate, should be at least 3 times your customer acquisition cost. So that's one thing that is kind of best practice in the industry. The other one is that the months to recover CAC. So let's say your customer acquisition cost is 100, and let's say you charge $10 a month. It's going to take you 10 months to recover your customer acquisition cost, and that's fine. So it needs to be under 12 months. So I'm showing you these two ratios, okay? And now let's go show an example, and let me explain to you why these ratios are so important and why unit economics are so important for a software company, but really for any company. So let's look at one example. Let's say your customer acquisition cost is 1,000. How do you get that? Let's say you have a salesperson. That's how these are calculated. You pay them 100,000. They bring you 100 customers a year. That's 1,000 per customer. Let's say you decided to charge. That's really important because a lot of people come to me and say, "How do we know how much to charge?" Where if you go through an exercise like that, then you know. Let's say they charge $50 a month. This is a software as a service. This is a software subscription that you charge monthly, let's say $50 a month. It costs you $1,000 to get a customer, and people leave you at 2%. 2% of the people leave you every month. That's a good churn. Most companies, you need to work towards it. But let's say that just for the sake of this example. Okay, let's start calculating the ratios because we wanna make sure that we satisfy these ratios. Okay, so going back, your LTV is 50 divided by 2%. That's the formula. It's 2,500. The month to recover CAC, which is the first ratio that I asked you to calculate, is 1,000 over 50, defined as the lifetime value by the customer acquisition cost. The customer acquisition cost divided by what you charge monthly. That's 20. That's too long. Okay. Why? Because I told you it should be under 12. That's what investors expect to see. And by the way, those ratios, the way that they were determined is that SaaS companies that have survived, this is kind of what they're showing. So these are healthy ratios, right? The other ratio, unit economic ratio that I showed you is lifetime value over customer acquisition cost. In our case, it's 2,500, which we calculated here, divided by 1,000, that's 2.5. That's too low. So you have a problem, okay, because your ratios are off. It's taking you too long to return your acquisition, and you're not making enough on the lifetime to pay back the acquisition cost. So this is the meaning of that. So how do you fix that? Okay. So if you look at these ratios, you can all figure out formulas. There's a few ways you can fix it. Again, this is not interactive, unfortunately. So this is the part where I would ask you, how do you fix it? But really, the key here is you want to lower your customer acquisition cost, and you want to increase your lifetime value. Okay. And these are the ways you can do that. You can increase your sales quota, which is not an easy thing to do because your salespeople are in high demand, and if you increase their quota, they'll go work somewhere else. You can reduce their salary, which is kind of the two components of that. So just by doing this exercise, it makes you think about a lot of things. It makes you think about salaries. It makes you think about quotas. It's a good management tool for your company. It's not just for your financial model. It has a lot of other benefits. For increasing LTV is the other thing you can think about. So how do you increase your lifetime value? Well, you can charge more, which again is not very easy because it's a competitive market. Or you can reduce the churn, which is always desirable. So the more people stay the longer their lifetime, okay? So let's see how we fix that. So this is the example that I showed you. Again, we're talking about unit economics for a software as a service company. So my solution, so I'm trying one solution here, is increase the monthly price. Okay, if you increase to 100, this is what happens. Your lifetime value increases to 5,000. You've doubled it. Your CAC, master recover CAC, now goes down to 10, which now you're charging more for the same customer acquisition cost. So that's so now you're fine. And your LTV to CAC, the ratio of lifetime value to customer acquisition cost, is now 5, which is over 3. So just by increasing this, we fixed all the problems. Now, as I mentioned, it's not so easy to increase what you charge. You know, we would also be so lucky if we could do that easily. So you probably have to tinker with a bunch of these together, just not just the MRR. But I just want to show a simple solution to that. So right there, you see how important it is to understand your unit economics, because what have we learned here? You know, it informs your pricing decision, your sales quota, your salary, your go-to-market strategy, which is one of the first questions that I was asked. What is your go-to-market strategy? Because you can't really build a customer acquisition cost if you don't know your go-to-market strategy. Your budgeting for marketing, your competitive positioning, like how much can you charge, hiring planning, funding needs, all of that, just working the unit economics, okay? So if you don't know your unit economics, if I see your financial model and I start asking you customer acquisition and you're like, I see a blank face, which I see a lot, I know that you don't know the answer to any of these questions as well, okay? So unit economics are very, very important, especially in industry like software, where the investors are very savvy. So they're going to test for it. They're going to do these calculations, and they're going to figure out very quickly that you have numbers in there that don't make sense. Okay, so that's number one. Number two is people metrics. Again, we're staying with a software company example. So when we talk about people, as I mentioned, people, payroll, is the largest cost item for a startup. Any startup that I know, even if you, and unless you do a lot of lab work and you have costs related to equipment or material or I don't know what scientific equipment that you need, really people, especially, you know, we're in the knowledge economy, people is the number one cost. Going back to a software company example, what you need to do really to know how many people you need is you need to build an organizational chart for your company. There's no going around that, okay? It's not an easy task, or not always. You don't have to do it to the nth degree of accuracy, but you need to have an idea, okay? And I recommend to do it at least for the next 2 years, although we're building a 5-year model, so then you could grow it, you know, proportionally. You need to know salaries. You need to know, it needs to be fully loaded. So when I talk about fully loaded, people are sometimes asking me, do I need to count bonuses or taxes? Or I would say everything. We're building a cash model. So you really need to know how much cash you need. And if you pay people bonuses, you pay them in cash, then they need to be in your model, okay? And I mean, there's all sorts of nuances to that, like employees versus contractors, and these things are very specific to the region you're in, so I'm not going to talk about that too much. But you kind of need to figure out how many people you need and how much are you paying them. This is a picture, and again, you'll get all my slides so you can, again, this is a template. This is not a generic template. This is something that we built for a customer, but you know, you can, there's many variations of that. So you can say that this is color-coded. There's various, the green part of this side here is your kind of what we call G&A, the general administrative, which is kind of your admin cost. Here in blue is your sales organization. For a software company, this is where you find most of the people, okay? And the R&D part on the right here, your engineering team. So I want to show an example of, again, we're talking about software companies, so I want to show the area inside the red circle and how do we build that, just to give you an example, Okay, so part of these people are fixed. Like the people on the left are fixed. Your accountant, your finance, your CFO. For a software company, if you're in the B2B, so we're talking about business to business, right, where you can start charge licensing from day one, you need a sales organization. You need a lot of people selling software. As I'm sure a lot of you have gotten these phone calls, and I'm getting too, by very relentless salespeople. Most of the money that these companies raise is not so much to build the software, actually. I mean, a lot of it, some of it goes here, obviously, but a lot of it goes into sales and marketing. So you need to understand that. So when you go into the software B2B business model, that's why I showed you the slides at the beginning. What is your business model? You're B2B. Your B2B means that not only that you can charge licensing, but also that you need a lot of people in marketing. So that informs your cost decisions as well. So let's look at that. So this is just an example. So when you're in the selling software or anything that you sell, pretty much, you need to understand your sales funnel. So this is just an example of, people are coming in, and then you do demos, and then you need the conversions. There's all sorts of things, and eventually we work it down to a quota. So this is figuring out that, based on how many hours you have in the day, how many people you need for each task. Let's say that this company figured out that every salesperson needs to sell 20 new accounts a month. Okay, so let's go with that. So let's go to the next slide. So let's say your revenue target is 2,400,000. These numbers are worked, so the example makes sense. Well, how many people do you need? That's my question, right? We're going from revenue to people, okay? Well, every new account needs to, you need 2,400 new accounts, right? Let's say the average annual revenue per account is 1,000. So you need, that's the next thing you figure out. How many accounts do you need? Well, how many people do you need to sell these accounts? Well, we said 20 accounts per person, right? So every person is expected to sell 240 new accounts a year. You also need support people. So if you remember the org chart that I showed you, it didn't just have salespeople, it had a whole organization. I'm just simplifying it, so I'm just looking at two parts of that, the salespeople and the support people. So we got two people, which is why we're doing that. So in order for you to have $2.4 million in sales, you need 10 people to sell it and 6 people to maintain it, okay, support, okay. If you want to grow faster, that's okay. Let's say you want to double your sales target to 4,800,000. Then you need to double the people. It's just as simple as that. Which means you need much more money than you can probably generate, especially in the SaaS company, which you do monthly. So you need much more funding. Okay, so it's really, really important to understand your people needs, because that really informs your funding needs and a lot of your other cost decisions that would allow you to grow as quickly as you want to grow. So we talked about people. The last one I want to talk about is industry benchmarks, and then I'm going to show you an example of a company that had everything wrong and how we can fix it. So when you talk about industry benchmarks, when you build costs, remember I showed you a model, an org chart that was color-coded. These are your kind of cost functions, and that's true for every company. So this is general enough to fit every situation. You have your G&A, general and administrative. You have your sales and marketing, and then you have your R&D. And each of these has a component of salaries, which is what we talked about, and then a component of overhead, which is kind of your fixed cost. And this chart is fairly self-explanatory. So you need to account for all of that, okay? And then you have your cost of goods sold, which is your direct cost, which is not much for a software company, but can be a lot if you're manufacturing. You have raw materials, you have manufacturing costs, etc. And once you have all of these models, so you model the people, then you model the overhead, and you pretty much do it from scratch. And some things ride on revenues like this, and some things are more fixed in nature. Now, one thing you want to look at is you kind of want to look at your expense metrics. And every industry has kind of their own benchmark. For a software company, as I told you, and this is based on real, so it's a function of your revenues, okay? And it's also a function of your industry. So let's say in the software as a service industry, so this is high, this is low, this is kind of the range. What this is telling us that at a level of revenue of 10 million, for example, your overall expenses, everything that I showed you here, your overall expenses should be in the range of 150% to 200% or to 180%, let's say, of your revenue. Wow, right? That's much, much, much higher than your revenue. That's almost double your revenue. That's why you see these companies raising a lot of money. You read about Uber. You read about a lot of these companies in the software business that raise insane amounts of money. The more they grow, the more money they raise. This is kind of this business model. Because of the metrics of the SaaS business model, it requires you to raise ever increasing amounts of money to keep growing. Eventually you get to when somebody buys you, eventually you kind of get to equilibrium, but not in the early years. So don't think. Yes.
Yeah, I'm sorry. Okay. Sorry to mention that we're kind of running out of time.
Okay.
So I don't know if you can maybe speed up a little bit and so that we can have time at least for a couple of questions that I think probably will.
Okay, sure. I didn't know that because we started a couple of minutes into it, so I didn't know how much time I have. Okay, I'll wrap it up. Okay.
All right. Thanks much.
Okay. I'll wrap it up in 5 minutes, and then hopefully people can stay, and I can stay. So another thing I want to show when it comes to ratios is the revenue per employee, which is another really important metric. And that one, again, is the function of your level of sales. So if you look on the left side here, the revenue per employee, the higher sales here, the higher the revenue, or, it kind of fluctuates. But it's important that when you build your model, you figure out that you have enough people to generate a certain amount of revenue. The revenue per employee metric, again, is a really important industry metric. Okay, so I wanted to show an example. I'll try and do it really quickly. So it'll take me a couple of minutes, and then I can open it up for questions if that's okay. So bringing it all together, I just want to show you. I want to focus on a few of the common financial modeling mistakes, and by now you can pretty much understand all of it because we've touched on a lot of these in the examples and in the concepts that I gave you. Not enough people in the model, not enough costs to support growth, and user metrics are out of normal range, which is kind of what we've been talking about. So I want to show you an example. This is a company that came to us with these numbers. And what you can see is I'll go through this quickly. I just want to highlight the line of revenues. You can see it's growing from 900,000 to 148 million. So you see a lot of things like that, and you intuitively say, geez, there's something wrong with the numbers. But how can we figure out exactly what is wrong with the numbers so we can fix the numbers? So we do a stress test. The first thing we figure out is, are there enough people in the model? So to figure out how many people you have in the model, you need to have an org chart. Now, this company didn't have an org chart. So what we did was we took the ratios that I showed you of revenue per employee. Okay, so these are the revenues that were shown to us. We took the revenue per employee benchmark, the one I showed you a few slides before, and we divided the revenues by that to figure out how many people are implied by this level of revenue. So for 148 million level of revenues, you actually need almost 650 people. If you look at the salaries that this company shows and divide it by the number of people that we figured out, you get to a salary that doesn't really make sense, $4,000. Doesn't make sense in the U.S. I'm sure it doesn't make sense anywhere. If we take actual salaries, which let's say 100,000 a year, and multiply it by the 650, we get salaries that are in the $65 million range. So what you're seeing here, just by the people, okay, just take the number of people, you see that there's not enough people in the model. Okay, you implied number of people 648. That would imply salaries of $65 million. However, this model is only showing salaries of 3 million. So we're way, 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 way off from where we need to be. So how do you fix it? You build an org chart. You figure out how many people you need. You might not be able to grow to $148 million in revenue. That's a very high growth. Okay. The second problem with this model is there's not enough cost to support growth, and that kind of goes to user acquisition cost, which this company was showing a user acquisition cost that goes to your customer acquisition cost that is very low. So you can see their number here is 30 cents to a quarter cent to 30 cents per user. And this is the number of users that they were expecting, 365 million users. If you use their user acquisition cost, you get to $4 million. However, if we use industry benchmark for what it actually costs to get a user, it's not 30 cents, it's $1.88. So, and this was a mobile app. So the user acquisition cost for 360 million users should be at least 686 million. Okay. So right there, this is somebody who doesn't know the unit economics. So they don't have the right amount of cost. And how do you know that? I mean, that's an example of an industry index that shows you user acquisition cost. And the last thing is the user metrics are out of range. The company was showing 365 million users. 365 million users. Where's my arrow? In year 5, out of them, 320 are active. Well, if you know anything about apps and games, or not even games, mobile apps in general, you can have 50 to 90% active users. The most you're going to have is close to 5%. So the problem here is that the revenues were calculated, again, the unit metrics were off. The company should have known that even if you get to 365 million users, you're never going to get 90 of them active. Okay, so that again goes to your unit metrics and your industry. This is kind of showing what happens with mobile app over time. Okay, so just to wrap it up, building a financial model, what are some of the key takeaways from that? There's a cost to growth, which we talked about a lot. The financial model should match the business model. We talked about that too. The financial modeling fundamentals should include your unit economics, your people metrics, and your industry ratios. And I showed you some of the common mistakes. Always make sure you have enough people, enough cost, and that you are within the industry metrics. And that's it for me today. Thank you. Sorry for running a couple of minutes over time, and I'm happy to take questions if we have time.
Thank you, Efrat. You've been super clear, super exhaustive, super fast for concentrating what you usually teach in several hours in less than an hour. It was very, very, very good. I always learn something new when I hear you talking about these things. So I hope that also the other participants enjoyed. I'm sure they did. I will leave maybe a minute to formulate for them questions if they do have questions. I do have one very, very practical. What we see
Sure.
usually in your presentations that are really advanced, and you're basically witnessing a reality that is a little bit different from the rest of the planet, because we know what happens in Silicon Valley. How and I'm sure that you've seen projects and business plans from companies that were not from that area. How different, how I would say maybe less prepared you saw companies, startups, compared to the ones that maybe come out of a university in the US, and maybe they're a little bit more accustomed to prepare documents that are richer with more details, more to the point. So how much work do you think is needed on average from a company that maybe is not that advanced in terms of knowledge on how to build the model?
Yes, so I have to say, unfortunately, I don't see a lot of difference. You would think that maybe a startup that spends time in Silicon Valley, they have exposure to a lot of events and workshops where they can or they talk to more investors on average than a company from outside of Silicon Valley. But really, I would say that this is really the last frontier. So I would say that companies have gone a long way in their understanding of planning their product, the lean, the lean startup concept, understanding your ecosystem, understanding your customer, what they need, iteration. The financial modeling area is not very well understood by anyone. It doesn't matter where you're from. It's the I would say that's why I started out by saying these are usually the two slides that nobody has. So I'm actually very surprised. It's not you don't see a lot of classes about it. The same with you have about marketing or go to market and all the other things, even in Silicon Valley. And that's why I do this talk. I mean, I'm one person, so I can't do, I do what I can do. But there's very little done of that. And a lot of the financial modeling is misinformed and it's just done the wrong way. And the investors are looking at it and they are discounting it. So they say, okay, let's take 1/10 of what they're telling us. And that's because you don't know, you can articulate really well your understanding of the fundamentals. And I think that if you can do that, the communication with investors would be better. But to your question, I don't see an advantage to a company from Silicon Valley in the financial modeling. Not yet. That's unfortunately is not the case.
Okay. Linking to that, I saw in the meantime 2 participants wrote a question. The first one is, do you expect a startup to have all the financial model ready from the very beginning? Question number 1. Question number 2, they are asking where you can find user metrics and standard industry costs for the different industry sectors.
Okay, so the question of from the beginning, I get a lot, and actually I alluded to that in one of my slides or in a few of my slides. So the one thing I expect you to do from the beginning is you might not have the pretty picture of the 5 years and that that it takes time to build, but you understanding your unit economics and your people needs, absolutely. So that's why I'm breaking it into components. So eventually you need to bring everything together. But if you just understand your unit economics and you know what you need to work on, and you understand your people needs, then the people needs, you've covered 90% of the money that you need. So so I think that I don't expect you to have a full shiny financial model from day one, but I expect to have a skeleton of that. I have to have a thinking about it. It can be ignored. So that's the one thing I'm trying to say here. To the other question was about where do you find your industry metrics. So most venture funding goes to software companies. That's I don't think I'm telling you a secret. So there's tons of metrics for the software industry that you could find. A lot of VCs are publishing studies. That's the first place I would go to. That's what I go to actually, because that's who is looking at your numbers. So you need to make sure you conform to their metrics. Okay. Other industries, you kind of have to. You won't find it in one place, but what I do is I look at a lot of. I do it for every client. If it's in a new industry, I always start about looking at companies that got funding. In that market, and I try to get as much information about them as I can. How many users they have, how much money did they raise, whatever they disclose about how they use the money, and I kind of build backwards from that. Some industries have different metrics that matter. If you're in the hardware manufacturing, then there's all sorts of manufacturing efficiency ratios that. You either have somebody in your team that knows that's also another way of getting the metrics, especially if you're manufacturing, you need to have somebody in your team that has the knowledge. But some of it you can find just by kind of combing information about companies that got funding. I always look at those because then you know how much money you need to raise too, and trying to walk backwards from that.
I hope this answers the question. Yes.
Okay.
It seems it does. Let's see. We have.
Thank you. Thank you all for staying.
Comments. Someone is typing. Yes. Good. So yeah, here it's I guess maybe 7:40 a.m. for you in
Yes,
California.
it is.
Yeah, so
Yeah, this is
ready
my
for
contact
breakfast.
information. Sure. No, no problem. This is my contact information, the last slide. And again, I know that you make the slides available. So,
Yes.
yeah,
Yes,
thank you.
absolutely. And also, let me remind the audience that we will have, as usual, the video of the webinar published in a week or two, as usual, and also the presentation will be available as a PDF. So we will upload everything in a week or so. And I would like to thank again, of course, the speaker, Efrat, for being up for us at 6:30 a.m., the audience on Friday afternoon, myself for being here on Friday night,
Just
and
like,
also like to tell you that we will have a next webinar at the almost at the end of March with details that are going to be published. And once again, thank for being with us, and I hope to see you again all soon. Thank you.
thank you all. Have a good weekend. Thank you very much.